What role does leverage play in speculative bubbles? Have you ever wondered how some investments seem to skyrocket in value overnight? This phenomenon often ties back to leverage, which is borrowing money to invest more than what you own. Leverage plays a big role in creating and amplifying speculative bubbles. When investors use leverage, they can buy more assets than they could with just their own funds. This increased buying power can push asset prices higher than what their true value should be. As prices rise, more investors may jump in, borrowing even more money to take advantage of the upward trend. This creates a feedback loop where rising prices lead to more borrowing, which in turn pushes prices even higher. The result? Rapid price inflation that often disconnects from the actual worth of the assets. Investors may become fixated on short-term gains fueled by borrowed money, rather than focusing on the long-term value of their investments. From a libertarian perspective, leverage itself is not a bad thing. It is simply a tool that investors choose to use in a market setting. The real issues arise when government policies interfere with market signals. For example, when central banks set artificially low interest rates or expand credit, it can encourage excessive borrowing. This makes credit too cheap and can inflate bubbles in a way that does not reflect true market conditions. Libertarians argue that speculative bubbles often result from these market distortions rather than from market failures. In a truly free market, where money is sound and there is no artificial credit expansion, leverage would be used more carefully. Borrowing costs would reflect actual risks, and investors would face the full consequences of their decisions without expecting government bailouts. To summarize, leverage increases investment capacity and can push asset prices beyond their fundamental values during speculative bubbles. It creates a cycle where rising prices encourage more borrowing, further inflating the bubble. Libertarianism views leverage as a neutral market mechanism, but government-induced credit distortions can lead to excessive leverage and speculative bubbles. Free markets with sound money and no artificial credit expansion would help limit harmful leverage by aligning borrowing costs with real risks and consequences. Addressing speculative bubbles may require reducing government interference in credit markets instead of restricting leverage itself.